In 2026, the UK could face a recession worse than 2008. Sounds dramatic, right? But the signs are already here. Inflation is spiraling out of control, energy prices are through the roof, and the country is dealing with massive labour shortages. Meanwhile, public sector strikes are crippling essential services and pushing the economy further into chaos. And that's just the beginning. The housing market is teetering on the edge, and the government's debt burden is getting heavier by the day. With the global economy slowing down and Brexit fallout still haunting the UK, the next few years could be even more brutal than anyone anticipated. What does all this mean for you? Let's dive into the 10 shocking reasons why the UK could be heading for its darkest economic crisis yet. Number 1. Global supply chain disruptions. The global supply chain has been severely impacted over the past few years, and it shows no signs of improvement anytime soon. Brexit, the COVID-19 pandemic, and ongoing geopolitical conflicts like the war in Ukraine have all contributed to supply chain disruptions that are hitting the UK economy hard. Businesses are struggling to secure raw materials, and delivery delays have become the norm. These disruptions not only affect manufacturers, but also retailers, who face increased costs as they try to keep products on the shelves. Shortages of goods have driven up prices, fueling inflation in the UK. Basic consumer goods, such as food, electronics, and furniture, are becoming more expensive, and the impact is felt by households across the country. Imagine walking into a store and finding fewer choices, with prices climbing higher for what's available. This has led to a decrease in consumer spending, as people are forced to allocate more of their income toward essentials, leaving less for other purchases. Another significant consequence of these supply chain disruptions is the rise in production costs. Manufacturers are finding it harder to meet demand, leading to delays and inefficiencies. When goods are finally delivered, they often come with a premium price tag, which then gets passed on to consumers. The UK's reliance on global trade means that these disruptions have a cascading effect throughout the economy. With fewer goods coming into the country and production processes stalling, many industries are facing slowdowns. This leads to a vicious cycle of inflation, rising costs, and shrinking demand. In a recession, this cycle can spiral even further, amplifying the economic pain felt by both businesses and everyday citizens alike. The disruption isn't just a short-term inconvenience, it's a major factor that could push the UK economy into a deeper recession. Number 2. Higher inflation rates. Inflation has become a pressing concern for the UK, and it's expected to remain high for the foreseeable future. Rising prices on everything from food to energy are eroding the purchasing power of households across the country. The surge in inflation is largely driven by increasing costs of raw materials, energy prices, and the lingering effects of the pandemic. As wages fail to keep pace with inflation, many individuals and families are feeling the financial strain. One of the main factors contributing to higher inflation rates is the energy crisis, with energy prices soaring due to disruptions in supply. Particularly after the Russian invasion of Ukraine, households are facing staggering utility bills. Gas and electricity prices are pushing up the overall cost of living, and many people are finding it increasingly difficult to make ends meet. For businesses, higher energy costs lead to increased operational expenses, which they often pass on to consumers in the form of higher prices. Another key contributor to inflation is the supply chain disruption mentioned earlier. These disruptions create shortages, which drive up the cost of many essential goods. Additionally, global demand for goods remains high, while supply struggles to meet it, causing prices to rise. This situation is compounded by Brexit, which has created trade barriers that further restrict supply and push prices higher. The combination of rising costs and stagnant wages means that real income is effectively shrinking. Families are finding themselves with less disposable income, forcing them to cut back on spending. As consumer demand drops, businesses may be forced to raise prices even further in an attempt to cover their increased costs, creating a vicious cycle that fuels even higher inflation rates. The sustained inflation is a significant threat to economic stability, particularly as it undermines the standard of living for many people in the UK. Number 3. Rising interest rates. The Bank of England has been gradually increasing interest rates in an effort to combat rising inflation. But this move has significant consequences for the UK economy. Higher interest rates make borrowing more expensive for both individuals and businesses. For consumers, this means that mortgage payments, credit card bills, and personal loans will become costlier. As borrowing costs rise, people are less likely to take out loans for big purchases like homes or cars, which leads to a slowdown in consumer spending. The impact is even more pronounced for businesses. Companies often rely on borrowed capital to fund growth, whether through loans or issuing bonds. As the cost of borrowing increases, many businesses will find it more difficult or expensive to expand. This can result in fewer investments in new projects, hiring, or research and development. Smaller businesses, in particular, may face significant challenges as they try to keep up with rising financial pressures. Without access to affordable credit, many companies might even delay or cancel planned expansion, which can lead to job losses and a general economic slowdown. Higher interest rates also put a strain on the housing market. With mortgage rates climbing, fewer people are able to afford homes, which could cause property prices to stagnate or even drop. For many homeowners, this means less equity in their homes, which can be particularly damaging if they need to sell. Additionally, a slowing housing market further weakens the economy by reducing consumer confidence and spending. As the Bank of England tries to balance the need for controlling inflation with the risks of stifling economic growth, the overall effect is a tightening of financial conditions that could push the UK closer to a recession. The higher interest rates will continue to have a ripple effect on the broader economy, deepening the financial challenges for households and businesses alike. Number 4. Global economic slowdown. The global economy is facing significant challenges that are spilling over into the UK, threatening to deepen the recession. Major economies, including the United States, China, and the Eurozone, are all experiencing slower growth, which impacts global trade and investment. As international demand for goods and services declines, the UK, being a trading nation, will inevitably feel the effects. The slowdown in key global markets directly reduces the demand for British exports, which could lead to lower sales and revenues for UK businesses. Manufacturing and exports have long been essential drivers of the UK economy. But with the global slowdown, UK manufacturers may face fewer opportunities to sell their products overseas. The reduction in export demand can lead to factory closures, lower productivity, and even job losses in key sectors like automotive manufacturing, electronics, and pharmaceuticals. The knock-on effect of this would be a stagnant economy, with fewer job opportunities and reduced incomes. Additionally, the slowdown in global investments could mean that British firms struggle to attract foreign capital. The UK has relied on foreign investments to fund business growth, infrastructure projects, and technology developments, but with the global economy facing uncertainty, investors may look elsewhere for more stable returns. This could lead to a reduction in investment within the UK, further dampening economic growth. The ripple effect of global economic issues doesn't just impact large corporations, it affects small businesses as well. Many rely on global supply chains and international trade, and disruptions in those markets can force them to scale back operations or close down altogether. As the global economic slowdown drags on, the UK faces the prospect of shrinking job markets and a weakened economy, further setting the stage for a deeper recession. Number 5. Brexit fallout. The long-term effects of Brexit continue to unfold, and they present a significant challenge to the UK economy, especially as it faces the prospect of a recession in 2026. While the UK officially left the European Union in 2020, the economic consequences are still very much felt today. The separation has created new trade barriers, regulatory challenges, and labour shortages, all of which have hindered the UK's ability to maintain the same economic momentum it once had as part of the EU. One of the major issues is the imposition of tariffs and customs checks on goods traded between the UK and the EU. While these measures were meant to control and regulate trade, they have only increased the cost of doing business. Companies now face longer delivery times, more paperwork, and higher costs when moving goods across borders. These trade disruptions not only affect large companies, but also hit small and medium-sized businesses, many of which rely heavily on the EU market for exports. Labour shortages are another significant consequence of Brexit. The UK has seen a sharp decline in the number of workers coming from the EU, particularly in industries like agriculture, hospitality, and healthcare. This has led to a skills gap and a shortage of workers, which in turn has driven up wages and operating costs. For businesses, this means less efficiency and higher expenses, leading to inflationary pressures that further strain the economy. Additionally, the loss of easy access to the EU single market has made it more difficult for the UK to remain competitive in industries such as manufacturing and technology. While some sectors have managed to adapt, many are struggling to cope with the added complexity and cost. As these issues continue to fester, the economic fallout from Brexit could make the UK's upcoming recession much more severe than the 2008 crisis. Number 6. Energy crisis. The energy crisis has been a major factor in exacerbating the UK's economic troubles, and it's likely to worsen as the country faces a potential recession in 2026. The rise in global energy prices, particularly following the Russian invasion of Ukraine, has pushed up costs for businesses and households alike. Gas and electricity prices have skyrocketed, leading to higher utility bills for families across the UK, adding financial stress to an already strained population. The UK's dependence on imported energy has made it vulnerable to fluctuations in the global energy market, with energy prices surging due to geopolitical tensions and disruptions in supply chains. The cost of powering homes, factories, and businesses has become unsustainable for many. In fact, millions of households are now facing fuel poverty, where a significant portion of their income goes towards paying energy bills, leaving them with less money to spend on other essentials. This creates a diminished standard of living, as families are forced to cut back on things like food, transport, and leisure activities. The business sector is not immune to the impact of the energy crisis either. Manufacturers, especially those in energy-intensive industries like steel, chemicals, and glass, are struggling to stay competitive due to the high cost of energy. With operating costs rising, many companies may decide to reduce production or even shut down, leading to potential job losses and reduced economic output. As the UK government continues to search for solutions, the long-term impact of this energy crisis may compound other economic issues, such as inflation and interest rate hikes. The combination of high energy costs and economic instability could push the UK closer to a recession, as both consumers and businesses face mounting financial pressures. The energy crisis is more than just an inconvenience. It's a driving force behind the country's economic downturn. Number 7. Shrinking workforce. The UK is facing a shrinking workforce, and this demographic trend is a major contributor to the economic challenges ahead. The ageing population in the UK means that a larger proportion of the workforce is reaching retirement age, and fewer younger people are entering the workforce to replace them. This imbalance is creating a labour shortage in key sectors, putting additional strain on an already fragile economy. With fewer workers available, productivity declines, and businesses are left scrambling to fill positions. Sectors like healthcare, construction, and hospitality are particularly vulnerable, as they depend heavily on a steady supply of workers. The skills gap is another issue, as many industries require specialised knowledge, and the UK is struggling to meet that demand. This results in higher wages for skilled workers, further driving up operational costs for businesses, which can then lead to inflation and decreased profitability. Brexit has also compounded this problem. New immigration policies have made it more difficult for workers from the EU to settle in the UK, exacerbating the labour shortage. Before Brexit, many industries relied on workers from Europe to fill lower-wage jobs. But with immigration restrictions in place, businesses are struggling to find the workers they need. In some industries, such as agriculture, transport, and healthcare, The reliance on foreign workers was particularly high, and the reduced influx of these workers is now causing significant disruptions. A shrinking workforce also means a reduced consumer base, which directly impacts demand for goods and services. As fewer people are employed, there is less disposable income in the economy, leading to decreased spending and a potential economic slowdown. If these trends continue, the UK's economic growth will be stunted, and the impact on living standards and productivity will push the country closer to a recession. Number 8. Housing market crisis. The UK housing market is facing a crisis that could have far-reaching consequences for the economy, particularly in the event of a recession. Property prices have been inflated for years, driven by a combination of low interest rates, government policies, and strong demand. However, these inflated prices are not sustainable in the long term, and a significant correction in the market is becoming increasingly likely. As interest rates rise, mortgage payments become more expensive, making it harder for potential buyers to enter the market. This creates a downward pressure on property values, potentially leading to a housing market collapse. For homeowners, a drop in property prices means they may face a reduced sense of wealth. Many people in the UK view their homes as their primary asset, and any significant loss in home value can have a devastating impact on household finances. Homeowners may also face difficulties selling their properties, especially if they need to downsize or relocate. For those with mortgages, this could result in negative equity, where the amount owed on the mortgage exceeds the value of the property itself. The housing market crisis also creates a domino effect on the broader economy. The housing sector supports many related industries, including construction, real estate, and home improvement. As the market slows, these sectors will see a reduction in activity, leading to job losses and a decrease in overall economic output. Moreover, people tend to spend more money when their homes increase in value, so a decline in property prices will likely reduce consumer confidence, resulting in lower spending on goods and services. The housing market crisis could ultimately serve as a tipping point, triggering a recession by tightening credit, reducing wealth, and causing broader economic slowdowns. With a sluggish housing market, economic recovery becomes more challenging, leading to deeper financial struggles for both individuals and businesses. Number 9. Public sector strikes and protests. In recent years, public sector strikes and protests have become increasingly common across the UK, and they are set to play a significant role in the country's economic downturn. A number of workers in vital sectors, such as healthcare, education, and transport, have been demanding better pay, improved working conditions, and protection against rising living costs. These labour disputes often involve significant disruptions to public services, and in times of economic uncertainty, they can worsen the situation by adding additional stress to already strained systems. One of the most notable examples of this is the ongoing series of NHS strikes, where doctors, nurses, and other healthcare staff have voiced concerns about pay disparities and workload increases. As the NHS already faces immense pressure due to an ageing population and staffing shortages, these strikes are only making it harder for the system to function effectively. When public sector workers, such as those in healthcare and education, withhold their services, it disrupts essential services, further deteriorating public trust and confidence. Moreover, strikes in transportation, from rail workers to airport staff, have caused significant disruption to people's daily lives. When workers protest in these critical industries, it results in delayed commutes, reduced productivity, and economic inefficiency. The added uncertainty of not knowing when or where the next strike will occur also discourages both consumers and investors, contributing to a lack of confidence in the UK's economic future. The public sector strikes and protests ultimately contribute to economic instability, which in turn can discourage investment and spending. When workers' rights are challenged and services are interrupted, it reflects broader frustrations with the economic system. This dissatisfaction further erodes public trust and undermines consumer confidence, adding another layer of complexity to the UK's already shaky economic outlook. Number 10. Debt burden. The UK's national debt has been steadily increasing in recent years, reaching levels that could significantly hinder economic recovery and contribute to a potential recession in 2026. The cost of servicing this debt has become a growing concern as the country faces higher interest rates and economic uncertainty. With an already high level of borrowing, the government's ability to fund public services and support economic growth is increasingly limited. The rising debt burden means that a larger portion of the government's budget is being directed toward debt repayments, leaving less money available for vital investments in infrastructure, healthcare, and education. The UK government has already borrowed heavily to fund COVID-19 relief measures and other pandemic-related expenses, and these debts are now coming due. While some argue that borrowing during times of crisis is necessary, the long-term impact is undeniable. Higher interest rates make it more expensive for the government to borrow money, further exacerbating the debt issue. As debt servicing costs increase, the government may be forced to cut spending or raise taxes to balance its budget, putting additional strain on an already fragile economy. For businesses, the UK's debt burden also creates uncertainty, as future tax hikes or cuts to public services could have long-term economic implications. Moreover, investors may become wary of the country's ability to manage its finances effectively, leading to a reduced confidence in the UK's economic stability. A lack of investor confidence can result in capital flight, where investments move to more stable economies, further weakening the pound and pushing the UK toward a recession. The debt burden is not just a fiscal issue, it's an economic one that can dampen growth, reduce opportunities, and increase financial volatility. As the debt continues to mount, the UK may find itself facing a vicious cycle of debt and austerity, making it even more difficult to recover from a recession. The UK's economic future hangs by a thread, and it's becoming clear that the 2026 recession could be far worse than the 2008 financial crisis. With global supply chain disruptions, soaring inflation, and energy price spikes, the country faces a perfect storm of financial strain. On top of that, the shrinking workforce and Brexit aftermath continue to create uncertainty. The housing market is teetering, public sector strikes are crippling vital services, and the government's mounting debt only adds to the overall instability. As we've seen, these factors have created a fragile economic environment that could spiral out of control, pushing the UK into an even deeper recession than we've ever witnessed. The full impact will be felt by individuals, businesses, and communities alike. It's a time of great uncertainty, and understanding these risks is crucial to preparing for what's ahead. So, what does all this mean for you, your savings, your job, or your business? The next few years could change the landscape of the UK economy forever. If you found this video insightful, please consider subscribing to our channel. It takes just one click, and it helps us continue to provide high-quality content. We've put a lot of effort into researching and delivering this video, and your support means the world to us. Don't forget to share your thoughts with us in the comments section below. How do you think these factors will affect you and the UK as a whole? We want to hear your opinions, and your feedback drives the future of our content. Join the conversation. Let's figure out what's next together.